and then look at it live as the data is being shared. Before we start though, as always, I need to stress that financial markets unfortunately is high risk, and there's a genuine risk that we'll lose all of our invested money. As well, I'm going to provide live market analysis here, but this is just my opinion. It's not market advice or trade ideas. I'm just sharing what I think is happening. We'll talk, of course, about risk to reward ratios and all of that. So if you're in the chat, if you can hear me and also hear me and see the screen, please say hello in the chat. I'm going to just assume that we are live. But yeah, if you can help me out with that, then check it out. You should as well be able to see me right now. So who am I? Well, my name is Alejandro Zambrano, and I'm a market analyst. I've been a market analyst for many years. I've been trading since 2006. And been the chief market strategist that will be the head of all the analysts in various brokers for many years now. And I've been trading since 2006, as I said before, and hopefully I can teach you something. And if you have any questions, again, just put them in the chat. Okay, so let's talk a little bit about the Non-Farm Payrolls. So the numbers are out in roughly 8 minutes from now. We'll share the numbers as they come out. We're going to be using the Thinkmarkets economic calendar for that inside of the client portal, but it's also available inside of ThinkTrader to get the data out and then see exactly how that impacts the market. So firstly, I'm assuming most of you guys know what Non-Farm Payrolls is, but if you don't, let me just explain what it is. So it is what it says here on the chat or on the slides. It's a key U.S. economic indicator that tells us how many new jobs were added into the U.S. labor market. Now, this is super interesting. Because there's a huge difference in the numbers. For example, up until March, people thought, government in the U.S. thought that that the U.S. economy added 2.9 million new jobs. Instead, they added 2.8 million. That's a drop of about 23%. That's quite a hefty drop, to be honest. And the challenge here is that can't really trust the numbers. Then why is it like that? Well, they talk and collect data from about 122 businesses, okay? And that is supposed to cover 666,000 work sites. The problem, though, it only represents 1.22% of all employer businesses in the country. At least that's what the data is telling me. So just 1.2%. So they don't ask everyone. Imagine you have a room of about 100 companies. They don't ask 1.22 how they have been doing. Have they hired? Have they fired? And this is what we use to understand if the U.S. economy added or subtracted jobs. And then we have the unemployment figures. So that is usually they call people and ask them, are you working? Are you looking for work? Because this is interesting. If you're not looking for work, you're not part of the unemployment figures, at least not the official one. So the unemployment rate, say if you have 10 people want to work, about 9 of them have jobs and 1 of them do not have a job. Then that means that the unemployment rate is 10%, okay? So, but they call them if they are saying, if you have these 10 people and then you call them maybe the 10th person after 6 months and they still don't have a job, they might ask them, hey, are you still looking? And they might say, I'm not looking. And that is removed. So suddenly it looks like more people are working percentage-wise. So that again is something we need to bear in mind. Now here again is a huge challenge because they gather data from about 60,000 households, okay, 60,000 homes. And that is 0.047% of all US households, okay? So again, these are just samples. But why are they crucial? It's because they let the US central bank know if they're going to cut or increase interest rates. Simple as that. Okay? So that is why it's super important. And right now, as we're heading into this event, there was, I think, about 30% probability that they're going to cut rates with 50 basis points. All right, 50 basis points. And the alternative is a quarter of a full percentage point, which is 25 basis points, which is quite the normal bit. So if the data today is really poor, then that could happen. And we could assume that gold is going to go up. We can assume that Euro USD is going to go up, and stock markets are probably going to go down to some extent. You know why? Because people say, oh, well, if the labor market is bad and people are losing their jobs, then we're heading into a recession. So that's why it all becomes a bit tricky. But we're going to try to look at that and try to make sense of it. And we'll see if my many years of experience brings any value. Me, personally, I don't usually trade the non-farm payrolls because it's very difficult. And I usually just trade after the data comes out. Or just skip the whole day because it becomes easier on Monday. But I'm up for the challenge. Let's give it a shot. So what's expected today? Well, it's expected that the U.S. economy added 164,000 new jobs. We'll double check that in a minute. And the unemployment rate to remain unchanged at 4.3, and that earnings remained at 0.3%, or that it increased by 0.3% monthly. Here you can see the numbers recently. So we're up at 3,500 at one point, 1,000 new jobs. We know now that a lot of this was just exaggerated numbers, and in fact they created far less jobs than expected. And you can see that last time the people thought we were going to get about 180,000 jobs. Instead we got substantially lower, 114 to be exact, and that was a huge surprise. And that actually caused dollar yen to move strongly to the downside, and also Euro USD. Here's the unemployment rate. It's picked up quite strongly. So it was at around 3.9%, and then pushed higher at 4.3. And this little rise here, when it rises a full percentage point, that tells people that we could be heading towards a recession, and that's what's worrying the market. And here's the jobless claims that tell us that the people that continue to be unemployed, they are at highs. So I'm skipping through quite quickly here, and we're actually going to skip all of this because we don't have time. But let's take a look at the charts. So overall, what I wanted to show you with the ISM figures, both the manufacturing and services, they are telling us that the data probably is not going to be too good, and initial jobless claims tells the same. So probably going to have a lower than expected outcome. Now let's take a look at the economic calendar, the latest one. So we get the latest figures. And let me just see. I'm just messing around here just a second. Okay, good. All right, so let's take a look here. So 160,000 is the latest reading that people think is going to happen. And then for the unemployment rate to be at 4.3%. So this is trading view, and this is I think markets is connected to that. So there is not the only thing that really makes a lot of sense to potentially trade on the spot is this. Okay, so this is gold. So gold prices are trading sideways. So they've been stuck here since Monday, August 19th. And this is the sort of all-time high. The actual all-time high is slightly here at 2,531. And if we push above here, it would trigger most likely a break. So this, we could treat this like a rectangle. And the rectangle tells us we can go all the way up towards 2,587. So the way to trade this, one could, if you wanted to, put a limit order to buy here, because it's only going to spike. Well, it realistically can only spike upwards if the numbers are bad. Alternatively, up here if the numbers, okay, so the numbers are out. Let's see here. It's going down already a little bit, so I suspect the data was maybe slightly better than expected. Let's take a look. Okay, so non-farm payrolls was 142. So less strong than expected. The unemployment rate, though, it improved from 4.3 to 4.2%. Now, I think this is the problem, okay? This is the big problem. Wage growth was 0.7%. That tells us that wages have increased with 0.7%, which is substantially higher than the 0.2 anticipated. And I think that's influencing gold. So let's take a look at gold. So as for the actual reading, it was lower than expected. And then we have wages. So overall, I would argue that this is a mildly, it's a bit bad, not massively bad, but it is a bit bad, okay? Will it trigger a break to the upside? I potentially think so. So let's take a look here. I would say if we break here, 2,529, I want to be bullish. And I want to be bullish. If I would have traded here, I'm not putting a live trade on here, but if I would have put a live trade on here, I would have put a stop at 2,514. So let's see. So that's the initial reaction here. I just want to see what's happening with Euro USD. So Euro USD, massive push to the upside. So this, what you're seeing here, you see here, I put this weak non-farm payrolls. I wanted to be a buyer here on a weak non-farm payrolls because we're already so high. Here right now, yeah, okay, you can go up a bit higher, but the risk to reward ratio is not going to be good. It's, in fact, it's going to be horrible. Like if we buy here right now, stop loss goes maybe on the bottom. So if we do like this and, you know, we look to do something like that, you know, okay, you make maybe 52 pip, but you risk to lose, well, 70 pip. So that's not great. That's why I wanted this here. So this is what happened here. It's just a mini price slide just before the data come out. Okay, maybe on that strong, wage number. Okay, that high wage number is the idea would be maybe it's a statistical error. I think maybe that's what people are looking at. Again, let's revisit here. Let's take a look at the data. The non-farm payrolls was 142. And yeah, I missed this. 89K. So it was revised lower. So the reading from last number, we said at the beginning that they thought it was 114. But this was revised to 89. So it's been revised quite strongly recently. So we might say, okay, maybe this is going to be revised too. So maybe, firstly, we're below the forecasted outcome. Okay, that's bad enough. Plus this one has been revised lower by 24 or so, and 25, no, yeah, 24 or so K. So you need to take that involved in mix with this, and you get a lower reading. On the other hand, the unemployment was slightly better than expected. So let's take a look at gold. What's happening here in gold? Okay, so gold hasn't triggered that level yet. Okay, it hasn't. That's actually good. We really like to see this. It's good when the price goes really close and then you get rejected, because the last thing you want to be is you just get triggered on an entry and then it comes down. So it's better it comes down before rather than after. So this is good. So I would say overall, I want to be bullish gold on a break to this level. I'm going to add a little alert. This is what you can do when you're on TradingView. You can do that, of course, with ThinkTrader as well, but it's easier here, I find it. Let's take a look at other markets. This is the GBP Swiss that we did not have time to work on. So this is the big issue. This is the big issue with trading non-farm payrolls. You see, you have a massive spike to the upside, and then you have a massive spike to the downside. Like that is the worst scenario. Okay, let's take a look. I prepared some other stuff. Let's take a look at this. This is the Dow. Everything went a bit quicker. I think next time we'll start a little bit earlier. So this was the Dow. So the Dow already to begin with was in a downtrend. Okay, it was already trading lower and lower. And with that in mind, I wanted to short sell on weak figures. So the idea was overall, this report is a bit weak, and it can, if we would correct to the upside, like we don't want to buy if the economy is not good. Okay, I hope that makes sense. If people are losing their jobs, they're not going to be able to buy stuff. Simple as that. So that's why I wanted to be bearish here. Now, if we spike up here again, I think I would be bearish again. Exactly, we can lower this a tiny bit like this. The general idea here with the Dow is that we had a really strong push here. So at the last non-farm payrolls, people got really worried about the economic situation. So the market dipped strongly, and now we just need to correct. I'm not saying we're going to go all the way down to the lows, at least not right now, but the idea is being bearish, like in the following fashion. So potentially risk 0.78%. And then if it comes down here, you get a 1-to-1. So you make, if you risk 1%, you make a 1% return. And if it dips a bit lower, you get maybe 2.5. Let's take a look at crypto. I want to take a look at crypto. Okay, so this is Bitcoin. Let me see here. Anytime you want to find something here, just put Thinkmarkets, BTC. That's how you find the price that is coming from Thinkmarkets. And you can actually trade here directly. You can create your own, it's linked to your ThinkTrader account. The best thing is just to go to the client portal. They will share instructions with you there how to connect it. But it's very straightforward. Down here, you would just find it. Hopefully it should be here. The exact instructions are on Thinkmarkets. Yeah, I'm not sure exactly why. There we go. There we go. So literally just hook this up, connect, and then it's going to ask you for the logins. I don't have the logins for this account right now, but you would connect there, and then whatever positions you have open would load here, and you can manage things as well. And soon, not yet, you will have it on the mobile app as well. So you just download TradingView, and then you connect your account there. That way, you can manage things on the go. The cool thing in general, which I like with this, is that most people, they will do their analysis on their laptop because you have a nice big screen. And then you prepare all of your alerts. And then, you go out to even if you're in your own house, you're on your phone, right? You get a notification. And then you open that notification, you get that alert. Like right now, we have an alert in gold. So as soon as that alert shows up, it pops up on your mobile and pops up here. And because you're already done your homework, you already know where you want to be buying. You already know where you want to put your stop loss. And this is actually very nice because when I started trading, we didn't have these alerts. So you had to put pending orders in. And the annoying bit with the pending order is that you can actually get triggered on a pending order. And then, maybe you did not want to enter at that point. Because what I always do is that I try to see, okay, what's happening with correlated markets? Like, what's happening here with Euro USD? What's happening here with dollar Swiss franc? And try to use that information to make a better assessment if I should enter or not. So we had a question here, if we permit traders from Zambia. Yes, we do permit traders from Zambia, so you guys are most welcome to join. I'm gonna load a few more things as well. By the way, we are hosting a live stream every Monday at 10. I think it was 9:30 London time on Facebook and on YouTube. That is me providing a general update on the markets. We discuss what's happening across Euro USD, gold, whatnot. So big picture overview. And of course, we talk levels and we talk trading in general as well. My colleagues here are making fun of me because I said in my days. Yeah. I started, I know I don't look that old. I started before you had the micro lots. That's how old I am. So you So the way Forex started, it started with a 10K lot, a 100K lot, which is what we call a lot. So you have to have quite a lot of money, and you need to have a contact with someone in the bank to be able to trade. And then in 1999, they introduced, there was two companies in the US that opened, and introduced the mini lot. So you could trade with a 10K position at that point, which was quite difficult on its own. And yeah, back then you didn't have alerts. My colleague laughs because it's interesting because you would put all these limit orders on. I would do that because I always trade breakouts. I love to trade a rectangle pattern. I like to trade at head and shoulders. That's how I make my money. And that's how I stayed profitable since 2008. And back then you put the limit orders on, and then you would, open you get a notification that the position was open, but you could be in loss really quickly. Okay, so I think, let me see here. So this is just a waiting game. Like half of the time is just waiting for the market to react. If you guys have any questions, by the way, you definitely want to put them in the chat right now, because otherwise we're gonna be wrapping things up. A good question here from Ioannis. So he's asking, what are my expectations for the Federal Reserve for their decision in the near future? So I would say because wage growth was so strong, and I would also say because the outcome, which was 140-ish, wasn't that bad. Okay, it's not that bad number. I would say they're gonna stick with a 25 basis point cut. So that's what I would argue. The bar to cut with 25 basis points I personally think was quite high, which would have required a number closer to definitely below 100, maybe even negative. A lot of people forget, but this number can turn negative. That is when the U.S. economy is losing jobs. And you know what? This is interesting for several reasons. Let me show you something here. So we got something called CME Fed Watch, which tells us what the expectations are for rate cuts in the future. So right now, there is a 51% probability of having a rate cut with 50 basis points, and 25% probability, or 49% probability of a 25 basis point cut. So I will be quite surprised if they would go and cut with 50 basis points. I will be quite surprised. Obviously, the market thinks differently, but because the numbers are the way they are, this, like in 12 days, people will need to, anybody that is still here, they would lose out. If they keep on betting on this and they don't increase, which on its own should actually provide support for the dollar. Okay, we will know more next week because we have the U.S. consumer price figures out next week. I think they are released. Let me see here. Inflation figures are due on September 11th, which should be Wednesday. So inflation is anticipated to be 2.6% annually, which is still quite high, but the Fed is obviously very confident that we're going to go down to 2%. And then we have core inflation, which is at 3.2%. So I would say if these numbers are much lower, maybe like 2.3, then that could definitely potentially trigger that 50% basis rate cut. But I don't really think that that's going to happen just yet. We had another question as well. So the top assets influenced by the non-farm payrolls is usually Euro USD, and so you can see here, and we also have the dollar yen. So the dollar yen tends to be massively impacted, but this is a typical sort of, this is a very number one reason why I don't trade in non-farm payrolls is because of this. You have a massive spike to the upside, and then you have a massive spike to the downside, which just makes life very difficult. But yeah, dollar yen, Euro USD, and the Nasdaq 100, of course. But look at it from this. The way I like to simplify the process is that I like to find things that are trading in a range like this. So this is a rectangle pattern. Okay, you got 1, 2, 3, 4, about 5 highs around the same spot. Okay, so this is a solid horizontal level. So that means that realistically, people that are short are having their stop loss orders just on the other side here. And if you push above there, it's going to trigger these stop loss orders. And if you're short and you close your position, you have to buy. Okay, that lifts the price to the upside. And here you have a very nice, well-defined level. So you can work on the break here because on its own is a pattern we can trade. And then you have the news, which overall was not that great. Okay, a bit mixed. And then you can combine this with your technicals. So now you're looking at this and you say like, okay, it went up. So it went up. Let me see if there's a drawing tool. So it went up like this. Okay. Now ideally it comes down like that and then swings up here. The reason why we would like to see this happening is because right now we need to work with a stop loss below here. But what we could do here later, if it spends some time here, is that we can reduce the stop loss. And when we reduce the stop loss, suddenly we get a better risk to reward ratio. So here the risk to reward ratio would be, it's on the wrong side. It would be like this. Something like this. So you would potentially make up to 8 times your risk. So if you risk 1%, you make 8%. Or if you risk $1,000, you make $8,000 return. The benefit as well of having a very good risk reward ratio is that you don't have to see the price trade all the way up. If it just trades slightly higher, you get still a very good risk to reward ratio of 4.34. So now the market has settled. This is good and bad. It's bad in a way that we can't put a position on right now, but it's really good for next week, because next week we now have 1, 2, 3, 4, 5. Now we have 6 highs here. And if we stay below that and break out next week, then realistically we'll create a new all-time high and push higher. And just for context, like in the case of Euro USD, I didn't start and look aggressively on Euro USD because Euro USD was already going up, right? It already had risen on the day and it was here far away from support. And the bar for this to head much higher is very high, because imagine you've already gone up quite a bit. For the data to go up, for the price to go up more, the data has to be even worse. And the data wasn't that bad, especially now with that wage figure. And that's why you get this massively choppy environment. But you could, to some extent, buy a dip here. Unfortunately, we didn't have time to cover that scenario. Okay, with that in mind, we're going to wrap things up. It looks like we don't have any more questions. Check out TradingView and Thinkmarkets. It's free to use. Just create your account, click register, and you access your portal. And then you just sign up, and then you're done. Okay, thanks so much for watching. Tune in next week. The market update should be at 9:30 London time. Thanks so much for watching, and I'll see you guys soon. Goodbye.